Thank you for joining us today, March 17th. Happy St. Patrick's Day. This is our first quarter 2022 Market Touchstones slideshow. My name is Paul Latta, and I'll be doing the narration today, but my business partner, Bosch Kochar, and I are both available for questions and discussion. Our contact information is available at our website, cedarrivercapital.com. Today, we'll start with a summary of the recent market action, what's hot and what's cold. And then we'll touch on the top 5 points of discussion amongst investors today. And then we'll conclude with a few broad points about market valuation levels. In the last 12 months, the S&P is up a nice 12.5%. But as you can see in the chart here, we were up over 20%, but have given up much of last year's gain in the first few months of the current year. S&P is down about 8% year to date through March 16th. Other indices, such as the NASDAQ and various foreign markets, are mostly off a little bit more than the S&P. There's a mix of headwinds and tailwinds buffeting the market, and we'll talk about those on the next slide. The slide does look at the headwinds and tailwinds of the current stock market. I'm going to start off with the headwinds on the right-hand side. We can see that right at the top of that list is the Federal Reserve, which has moved rather abruptly from last quarter's dovish quantitative easing to this year's hawkish rate increases, a 180-degree move necessitated by inflationary pressures throughout the global supply chain. Russia's invasion of Ukraine has exacerbated the inflationary pressures and the need to lift rates, not just at the U.S. central bank, but central banks worldwide. The third on the list here, China weakness, regulatory and geopolitical challenges with China have weighed heavily on U.S.-listed Chinese equities. And then, of course, our last point on the bottom right-hand side, the pullback in 2022 might actually just be a healthy consolidation given the enormously strong 2020 and 2021. Let's look at the left-hand side of this table here. Important not to lose sight of the tailwinds. Top of that list is improving prospects for COVID recovery worldwide. While we may not be fully out of the woods, the outlook is better than the last several quarters. Secondly, valuations have improved, partly on the market pullback, but also on improved earnings projections. The economy is still healthy, full employment, solid 401k contributions. And then lastly, alternatives to stocks like bonds, well, they really do remain unappealing with low rates and likely losses going forward, so stocks look comparatively more attractive. This slide shows market performance by style factor. In the far right-hand column, you can see performance year-to-date through mid-March. At a broad level, the style ranking reflects a ranking by defensiveness. Income, value, low volatility, or the top 3 are inherently more defensive than growth, story stocks, and momentum at the bottom. Another factor at play is sector rotation away from the names that performed well last year, such as large tech names, but cannot be sold in a strong market year where investors already had too many taxable gains. Also, inflation posturing into hedges such as real estate investment trusts rippled through year-to-date performance. We've compiled a top 5 list of the most pressing discussion points to address. As you can see here, they are the Ukraine invasion, COVID recovery, central bank policy, China weakness, and growth versus value. We'll begin our top 5 list with Russia's invasion of Ukraine. Certainly, this discussion point is the one generating the most headlines. As we know, Russia officially recognized the breakaway states of Donetsk and Luhansk as independent republics about 3 weeks ago, and then immediately launched a full-scale invasion into Ukraine, seeking, in Putin's words, the demilitarization and denazification of the Ukraine. Putin listed a lengthy litany of allegations, mostly aimed at escalating NATO presence, including the dozen allegations listed here on this slide, and more. Naturally, there are varying levels of merit to each of these allegations. Regardless, the invasion has rippled through the world economy in a variety of ways, with a disproportionate impact coming from raw materials and commodities, businesses where Russia and Ukraine have an outsized presence. This chart on the left shows arguably the biggest pain point related to the Ukraine invasion, the enormous increase in the price of European natural gas. This chart's a 5-year chart, which clearly predates the invasion, but also highlights that European natural gas prices were already hotly controversial before the invasion. So why have European natural gas prices risen tenfold faster than U.S. natural gas prices? The root problem was Germany's over-reliance on solar and wind generation amid an unusual autumn where the wind did not blow and the sun did not shine. Ironically, the savior to that bind was Russia's soon-to-be-approved Nord Stream 2 pipeline straight from St. Petersburg to Germany, bypassing the Ukraine, which has been a choke point for Russia since about 75% of Russia's gas to Europe goes through the Ukraine. Alas, though, as Russia alleges, the NATO card was played and Russia then invaded Ukraine and the already elevated gas prices exploded to new all-time highs. There might be a long-term shift in priorities here, putting geopolitical stability ahead of expanding any solar generation in Germany going forward. Other commodities have also rallied, though not as explosively as European natural gas. Oil makes the most headlines, though the spike in oil since the invasion did not really seem to last. Most of the base metals like copper and iron ore similarly spiked on war shortage fears, but then immediately softened on economic demand fears. In contrast, most of the agricultural commodities spiked and the lift appears to be sticking. The ripple effect of increased commodity prices has started to push through the value chain, aggravating industries like shipping that were already wrestling with supply chain issues around COVID. Defense companies have not seen much movement in earnings estimates, but any military activity always ripples through to the defense stocks. While the entire commodity basket lifted with the Ukraine invasion, clearly some commodities are impacted more than others. The next slide gives just a simple roadmap to which commodities will move the least and which ones will move the most. This slide shows the three main categories of commodities: energy, agriculture, and metals, but then further divides these three categories into global versus regional. Some commodities, like crude oil, are priced globally, meaning that crude oil is basically the same price everywhere in the world at the same time. If prices move up in, say, just Tokyo, well, then crude carriers show up to drop the price of oil to the world clearing price. Regional commodities do not have a world clearing price, typically because they are expensive to ship or because they are highly perishable. Natural gas, for example, is a regional commodity because it's typically tied to a pipeline network, and while it can be shipped by liquefied natural gas, or LNG, such shipments involve a high capital investment in LNG liquefaction and gasification facilities and LNG ships. Hence, very little natural gas is shipped worldwide via LNG, and natural gas remains a regional commodity. This explains why Europe natural gas prices have lifted tenfold higher than US natural gas prices. There's just no way to arbitrage that price spread. For investors looking to make a play on commodity futures based on the Ukraine invasion, the most appealing choice would then seem to be a Europe regional commodity that is not economically sensitive. European cheese prices, for example, have lifted by nearly 100% this year, and they appear to be sticking. The least appealing choice would seem to be the opposite, a global commodity that is highly economically sensitive, such as copper or iron ore. Anyway, that's a brief roadmap for the commodities. Returning now to our top 5 list, here at number 4, this slide shows that the US appears to be putting the Omicron spike behind us and hopefully COVID behind us. Masking requirements continue to be lifted. This ought to be a nice earnings tailwind for those return to work stocks like airlines and office REITs. And of course, it will be an earnings headwind for work from home stocks like maybe Zoom Video or Domino's Pizza or Netflix. Of course, the market has been anticipating return to work for some time, so the idea of buying airline stocks because COVID will go away, well, you're probably a couple years too late. There might be a little bit of alpha, but not much. Not to rain on the COVID recovery parade, but there has been some disturbing developments in Europe. This chart shows the United Kingdom infection rates initially declined post-Omicron, but now that the UK has dropped masking requirements, we're actually seeing a secondary spike in COVID infections. And this is actually not just the United Kingdom. About half the countries in Europe are seeing identical experience. Will the US see the same secondary infection spike? It actually does seem like we will get a lift, though it might help that the US is a little bit further south than Europe and about a month behind Europe, and so we might get some help from better weather and a little bit more outdoor experience. On to number 3 on our top 5 list. The Fed was in the news in a high-profile way this week. The Fed announced the completion of the tapering of its quantitative easing program, and it bumped interest rates higher by a quarter point. This is the first rate increase since COVID, and the Fed plans to do 6 more rate increases over the balance of the year. The chart here shows the Fed funds rate, a rate that's been obstinately close to zero for most of the last 14 years since the 2008 recession. This chart, by the way, goes back about 40 years. Of course, today we have high wage inflation, high CPI inflation, high PPI inflation, all running between 5 and 10% a year. This is the highest inflation number since 1982, so the Fed funds will be headed higher. A rising rate environment is a headwind for the stock market in general, but some stocks are more sensitive than others. This chart shows that there are 3 categories of stocks that are sensitive to higher rates. Curiously, the category on the right, the stocks with the elevated valuations, well, that category is under tremendous pressure at present. The other 2 categories are seeing comparatively little pressure. Why are we getting such a skewed response? Each category has a separate answer. In the case of the category on the right, the highly valued stocks, the challenge has been twofold. First, the story stocks had an enormous run post-COVID, with many of these names seeing 100%, 200% type returns. Second, the rise in story stocks opened the capital markets window to some 700 plus IPOs and SPACs, a level not seen since the dot-com bubble of 1999. So the supply basically exceeded the demand, and a correction was due even before the Fed started raising rates. The other two categories are holding up a little bit better, mainly thanks to the presence of stocks that are inflation beneficiaries. Base metals in the case of the category on the left of economically sensitive stocks, and real estate for the category in the middle, the high dividend stocks. So amid a hawkish Fed, both of these categories are vulnerable, though the category on the left, the economically sensitive stocks, well, those are probably the more vulnerable of the two. Number 2 on our top 5 list countdown is the so-called Chinese bear market. Yes, the US listed names have been getting pummeled, down some 60%. Hong Kong index is also down, a little bit less, at down 26% year to date, still a bear market. But in Shanghai, the stock market is nearly unfazed, down about 7% year to date. Well, that's actually better than the S&P, which is down about 8% year to date. There's several risk factors emanating from China's geopolitical ambitions. As shown here on the left, we can see the context of controversial military moves in the South China Sea, rhetoric about Taiwan, history of state self-interest. But in the last year, China has really cracked down on a wide swath of industries under the rubric of common prosperity, and this to the detriment of many industries such as online education, social media, real estate, and others. Still, the increased risk is not really moving the Shanghai market. At some level, the lack of movement in Shanghai market reflects the fact that Shanghai investors cannot really easily move to stocks that are listed in New York or London. Still, US delisting risk is the big factor for why, say, Alibaba, listed here in New York, is down 60% in the last year, but Queiqiao Spirits, listed in Shanghai, is largely unchanged. There are signs just this week that Shanghai may soften its resistance to US listing requirement. Time will tell. Our final item on our top 5 list is the discussion on growth versus value stocks. This is a long-standing debate on Wall Street. The slide shows value outperforming growth by some 12 percentage points year to date. Yet in the first quarter a year ago, value outperformed growth by a near identical 11%, only to give up that lead in the subsequent 3 quarters of the year. Will 2022 see the same relative performance on growth versus value? Perhaps so. Indeed, many of the causal factors driving last year's one-quarter outperformance are the same in 2022. Tax factors are right at the top of the list. No one wanted to take yet another capital gain on their large-cap tech stocks in December, so they all waited to January, and large tech stocks then took a beating as everybody pressed the sell button at the exact same time, 2 years in a row. Add to this a return-to-work theme that benefits value names more than growth names, and the odds are we will have a repeat of 2021. Oil stocks are not a huge part of the S&P at only 4.2%, especially compared to technology at 27%. Most growth indices have zero oil stocks, whereas value indices are actually overweight oil stocks. Oil has done well on a return-to-work thesis and amid supply chain constraints. Oil stocks are also an historic inflation hedge, the opposite of technology stocks, which get hurt in an inflationary environment. So oil was the hot sector even prior to the Ukraine invasion. Being a small sector, it does not take much rotation from tech into oil to move the sector meaningfully higher. Oil stocks have actually lagged the move in the underlying commodity, as shown on the picture on the left. Now, there might be some merit here since the oil futures curve, the picture on the right, is actually sharply backward-dated, forecasting oil will drop nearly 50% within the next 7 years. While the futures curve does not have a great track record of forecasting, especially during periods of fundamental structural change like 1973 or 2003, most analysts do acknowledge excess just-in-case stocking is propping up prices above baseline norms. With that futures curve, it doesn't really appear like this is a good time to be investing in oil. However, most folks that are buying oil are buying it as an insurance policy in light of the fact that we have a potential black swan risk with the Russia-Ukraine situation. I'd like to conclude our presentation today with 2 slides on overall market valuation. This first picture shows the PE ratio on the S&P 500. It's now back at pre-COVID levels. That reflects both the market pullback we've seen here year to date, as well as the increased earnings estimates for companies from the S&P 500. Well, that's a good combination. Not shown here is the interest rate on the benchmark 10-year Treasury, which at today's rate of 2.2% is almost exactly at the same level as pre-COVID. Now, of course, the shorter maturities are still on the low side, but the Fed is actively raising rates and aiming for a return to normal pre-COVID times. This is our final slide today, a slide that we have used before showing that stocks are cheap relative to bonds. Specifically, if one looks at the earnings to price ratio of stocks and compare it to the interest to price ratio for bonds, the valuation discrepancy is enormous. Stocks are some 60% undervalued using this metric. Of course, this discrepancy has been persistent for some 20 years, so we don't expect the gap to close tomorrow. But what we like about this metric is that it divorces stocks from the shop-worn idea that a PE of 10 is cheap and a PE of 30 is expensive, but with no regard for alternative investments such as bonds or real estate and where they trade. Indeed, compared to most bonds, and indeed compared to real estate, stocks simply offer a more compelling value. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.